Welcome to The Man from Macro, where we look at some of the big themes in today's global markets. This week, I want to look at the US labour market. After the recent decline in US initial jobless claims sparked a flurry of debate on Twitter. First, let's look at some of the data points at face value. Initial jobless claims are, again, close to their lowest level in 50 years. This should matter, because initial claims have bottomed and then started to rise long before every recession since the 1960s. Currently, initial claims are going in the wrong direction to imply an imminent economic contraction, even though the January 25th release rebounded from the recent lows. Please note, I've effectively excluded the COVID recession because that was an exogenous shock. I even had to truncate the y-axis on the chart because claims on that occasion dwarfed everything before or since. But why is there all the fuss about employment? Well, that's because rising unemployment has been the defining factor of all the recessions since the war. Unsurprisingly, given the trend in initial jobless claims, the unemployment rate also bottoms and begins to rise into each recession. Each recession has seen the unemployment rate accelerate. And that matters because the S&P has always seen a tradable low through each of those recessions. Whilst 1980 and 1991 weren't that impressive, most of the other lows were full-blown bear markets. So, given the current direction of initial claims and very low unemployment rate, does that mean that the economy is strong? Anna Wong, the chief US economist for Bloomberg, published an article last week suggesting that the jobs market might not be as tight as the decline in initial jobless claims suggests. In short, and to quote Anna from her Twitter feed, less unemployed people are applying for claims, meaning that the low level doesn't mean what it used to mean. Part of the reason, Anna explains, is because insurance eligibility is low for a pre-recessionary period, and recent inflation means that unemployment insurance has lagged the cost of living. Put another way, the benefits of collecting insurance are so low that people may be looking for multiple jobs in the gig economy rather than scrape by whilst claiming benefits. This in turn has depressed the initial claims figures in the same way that people who want a job but have dropped out of the labour force can lower the unemployment rate. So it seems that the labour market might be a false signal, something that Real Vision contributor Mike Green has been arguing for some time. I've also argued that the US jobs market can still be considered tight today, but not strong. A strong market is one in which real wages are rising and labour have power over capital. But for those who are still anticipating a recession, change may be afoot. The NFIB Small Business Survey on job openings has already turned lower, albeit from an extreme peak. A downturn in job openings has usually coincided with an upturn in the unemployment rate, though once again the lag time between unemployment picking up and a recession kicking in can be considerable. But even if the unemployment rate does start to rise, what matters for investors is whether it has a negative impact on the equity market. History suggests that markets will still struggle if a recession occurs. But will liquidity trump a rising unemployment rate this time? It's still all to play for. There are very plausible cases for both the bulls and the bears, and neither side should dismiss the other's argument, even if they don't agree with it. That said, please remember, none of this is investment advice. These are just observations for educational purposes only, and everyone should be aware of their own investment objectives and risk profiles. But thanks for watching.